What's up everybody, Nate here, and it looks like the housing market's problems are going from bad to worse in 2022. Over the last couple of months, housing market sales have declined by around 20%, leading many people to believe that the housing market is currently in a recession. Meanwhile, housing inventory has exploded all throughout the United States, and prices just keep getting higher and higher. Although according to investment bank Goldman Sachs, that is all about to change. Their outlook for the rest of 2022 is not great for the housing market. In fact, they believe prices are going to go into the negatives, and they believe that sales and, well, everything else in the housing market could continue this downturn throughout 2023. So today I want to talk about this Goldman Sachs report. I want to go over everything that's happening in the housing market right now, and I want to show you what you can expect to see from the housing market in 2023 and beyond. Now, according to Goldman Sachs, there are two major reasons why the housing market is kind of going through it in 2022. The first has to do with buyer expectations, their behaviors, and of course, home building. Home building especially exploded over the last couple of years because there was a huge spark in demand for homes. Because of the pandemic, the Federal Reserve actually dropped their benchmark interest rates to 0%, making it really easy for consumers and Americans alike to go out and get a mortgage loan. They could save hundreds of dollars every single month, so yeah, people took advantage of that. Not only that, but there was a lot of federal stimulus, so we had bank accounts growing and people had the option of getting a much lower interest rate, so we had a lot of money circulating around, and of course, many Americans decided to capitalize on this and get a home, but that led to a big problem in the housing market because there simply was not enough homes available, and builders were kind of capitalizing on the opportunities to take out loans themselves and start to build a lot of houses. But now things are completely flipped in the housing market because mortgage interest rates have started to rise and people don't have as much money as they did just 2 years ago. That means people are not going out and getting as many homes, leaving all of these home builders with homes but no people to buy them. And not only that, but inflation is hurting consumers and it's hurting home builders. They're not able to create these homes at a cost-effective level anymore, and that means that they're not able to sell them at the same price that they would have been able to just 2 years ago. But the other thing has to do with buyer psychology, behavior, and of course expectations. The expectation in the housing market right now is that prices are still getting out of control, and that means that people don't want to rush into getting a house in 2022. They want to wait till prices calm down. They want to wait until they're starting to make more money or until inflation goes down. People are spending a lot more money on basic goods and services in 2022, so they don't want to go out and buy a home if they're not going to be able to afford it just 2 years from now. And they want to look at these interest rates and wait till they come down too, because it doesn't really make much sense to sell your home or to get into a home if you're going to have to spend hundreds of extra dollars just funding it in your mortgage interest rate. And mortgage interest rates hit a new record high of around 5.6%, almost 6% for a 30-year fixed mortgage in the United States just this week. Now, the other thing has to do with psychology. So a lot of people are looking at home ownership right now and deciding that it's really not for them. And I kind of get that considering the pandemic and, well, people were stuck inside for a very long time over the last couple of years. A lot of Americans now want to rent or they just want to go out and travel, and right now is not the best time to buy a home, especially with things kind of opening back up and life feeling like normal after the pandemic. And because things are getting a little bit better in the cities and it's making more sense for people to go back to them, well, people are starting to move out of the suburbs back to the cities, and that means that they don't really need that mortgage anymore. And that's increasing the amount of home inventory that we have on the market because people are going back to the cities, and we kind of have this migration going on in the United States right now. And the other thing that Goldman Sachs is looking at is the Federal Reserve. The Fed plays a huge role in housing market demand, and right now they are causing demand to go way down. Because they are raising their interest rates so quickly and aggressively, that means many Americans can no longer afford to get a mortgage. So even if they wanted to buy a home, they simply can't afford one because interest rates are getting really high. Now, it's important to mention here that the Federal Reserve does not directly control what interest rates are going to be for banks. The way that it basically works is that banks get their money from the Federal Reserve, and when they get their money, they pay a certain interest rate. But we also pay an interest rate when we get our money from the bank, and those interest rates are very different. So when the Federal Reserve makes it difficult for banks to get their money, the bank will make it much more difficult for regular people to use their money. Hence why interest rates go up and millions of people can't afford a mortgage. The reason they're doing this is to bring down inflation, and by bringing down the housing market and bringing down prices and demand, that effectively lowers inflation in our economy. That is exactly what the Federal Reserve wants to do. Now, with that being said, Goldman Sachs believe that we are going to see some negative quarters and some negative years for the housing market ahead. Throughout the entire rest of 2022, Goldman Sachs sees a downturn. Home sales could decline by around 8%, and they could get even worse into 2023, and that's exactly linked to the Federal Reserve and our economy. Right now, the federal funds rate for banks and other financial institutions is around 2.25 to 2.5%. It was pretty much zero over the last couple of years, so that meant that millions of people could get a mortgage very easily. They could borrow money, and that kind of stimulated our entire economy and kept us out of a recession because of the pandemic. The federal funds rate is kind of seen as neutral right now, meaning it's not hurting our economy's growth that much, but it's also not stifling growth either. But that's not really good to bring down inflation, so the Fed is going to have to look at a variety of different factors and decide if they're going to continue to raise their interest rates, and right now it looks like they are definitely going to do that throughout the rest of 2022 and into 2023. As they do that, more and more people are going to be unable to buy a home because interest rates are going up. We could see them into 7 and 8% by the end of next year, and demand is going to be flat out zero. This means Goldman Sachs is also predicting that housing prices are going to come down in the United States. By the end of 2022, housing growth is only going to be around 5% year over year, and in 2023, it's going to be even worse, only around 1.8% according to Goldman Sachs. So we are going to see just very small price growth over the next year and a half or so, but things are not going to explode like they have over the last couple of years. In August 2022, year over year housing price growth was 14.6%, some of the highest we have seen in American history. But Goldman Sachs actually does see this phenomenon kind of ending into 2024. They believe that economic conditions are going to be conducive to the housing market actually starting to grow again, and we could see regular growth of around 3 to 5% in 2024. Now, like I said, Goldman Sachs does not see an outright crash happening. An outright crash would mean that we have all of this supply but zero demand. So you have actually higher supply than there is demand on the market, and we have seen that in the United States, like back during the 2007 housing market crash. Goldman Sachs, though, actually sees some price growth happening in the housing market, and the reason being is because they think that the jobs market is going to remain strong. The first and biggest way that Americans afford their house is through their income at their job, and many Americans are employed right now. The Federal Reserve has talked a lot about this. They believe that the labor market is tight and unemployment is historically low at around 3.5% as of July 2022. So many people are employed, and if they stay employed, then they're going to be able to afford their mortgage, meaning we won't see as many delinquencies as we did pre-pandemic, and there just won't be as many foreclosures. I will say foreclosures and delinquencies have gone up, but they're going up from a historic low. They are still at a historic low as of September 2022. Obviously, that can change as the Federal Reserve raises their interest rates once again. That's going to hit everybody differently, especially businesses. If businesses can't recoup a lot of these losses in revenue, then they're going to have to cut people. We've already started to see massive layoffs in 2022, and that's probably going to continue to happen into 2023. But are these layoffs just because a lot of these companies overhired, or are they because a lot of these companies are trying to stay afloat? If it's the first one, then yeah, you're going to see unemployment rise, but it's not going to be crazy high like it was in 2020. If it's the second one, then unemployment could get even higher, and that could actually mean the housing market goes into the negatives. We could actually see prices go down by 10% in 2023. What they're predicting, though, is that housing prices from where they are at right now are definitely going to come down across the board in the United States. Yes, there's going to be some areas in the country where we only see a very small price decline, and other areas where the price decline is going to be absolutely massive. It's going to depend on the housing market and the demand for that area. But there is going to be some decline, but across the nation, we're not going to see a massive price decline, and that's because home demand is still going to be relatively high in the United States. As more inventory comes on the market, as people stay employed, that means they can still buy houses, but now they just have a lot more options, meaning that prices come down. There's going to be Americans that still buy homes at 6, 7, 8% interest rates, just like we saw people buy homes when interest rates for a 30-year fixed mortgage were around 15 to 16% on average in the 1980s. The Fed was fighting a similar problem back then with inflation and had to raise their interest rates aggressively in order to bring it down. That, of course, meant that it was really hard to get a mortgage, but people still went out and got one anyway. Now, of course, price deceleration is just going to speed up in certain areas of the country because we're heading into the latter parts of the year. Usually by the end of the year during the coldest months, well, a lot of Americans just aren't buying as many houses. That could mean that prices go down even faster and into the first or second quarter of 2023. I mean, nobody really wants to move their house in the winter. Of course, there's some parts in the country that stay warm pretty much all year round, and they're not going to be as affected by this. Like I said, it just depends on the area that you live in. Now, as far as what you can expect to see in the future, well, the Federal Reserve is pretty cyclical when it comes to this, meaning that this has happened before in pretty much a cycle. Back in 2013 through 2017, that was the longest period of housing market prosperity basically in the last 30 or 40 years. This all comes from the Great Recession and the housing market crash of 2007. The Federal Reserve started to raise their interest rates in 2006 and basically kept them there until 2007 when the housing market crashed. They then decided to stimulate the economy by lowering interest rates once again, which caused a lot of people to go out and buy houses. Interest rates stayed there, quantitative easing was going on, and there was all of this money circulating throughout the economy. The Federal Reserve then started to raise their interest rates between 2015 and 2017, and then of course drop them completely in 2020 in response to the pandemic. But what you need to kind of take into consideration here is when the Federal Reserve stops raising their interest rates. This has happened in 2001, 2007, and of course 2020. The Federal Reserve basically will raise their interest rates and then they'll plateau for a certain period of time, usually right around a bubble or right around when inflation is a problem. Then they will have to drop them in order to stimulate the economy, but eventually they're going to start raising them again, but they will plateau after a certain number of years. It took the Fed about 7 years to start raising interest rates after the Great Recession, so if we see a recession in 2023, well, then we could actually see the Federal Reserve keep its interest rates very low for a long time. But usually once the Federal Reserve stops raising its interest rates, well, then that means to you that they're probably going to flip at some point and that economic disasters are coming soon. That means that they are probably going to lower their interest rates once again. So pay attention to what the federal funds rate is in the United States. If you see the Federal Reserve stop raising their interest rates and flatten out, then you can probably guess that within the next year or two, the Fed is going to lower their interest rates again, meaning that that is going to be a much bigger and better time for the housing market because millions of people are going to jump back in as buyers. But right now, interest rates are on the upswing, so until the Federal Reserve stops raising them, the housing market is probably going to be very expensive and very hard to break into in the United States. But now I want to hear from you on this issue. What do you think about Goldman Sachs and their prediction for the housing market for the rest of 2022 and into 2023? Do you think that they're spot on saying that sales are going to decline and home prices are also going to slow down for pretty much the next year and a half? Or do you see a housing market explosion happening around the horizon? Whatever your thoughts are, leave a comment below before you go. But that is it for today's business and financial news breakdown. Thank you so much for watching. If you want to stay up to date with all the top business and financial news from around the country, our team puts together a free daily newsletter, and you can subscribe to it by clicking the link in this corner right here. And if you want to stay up to date with me and everything else happening in the business and financial world, I'm putting out updates 7 days a week over here on this channel, and I've actually got another one ready for you right here, so be sure to check that out before you go. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.